The IRS has a tax rate of 0% on investment gains. Not 0% for the ultra-wealthy with offshore accounts and complex trusts. 0% for ordinary Americans, millions of them, who meet a straightforward income threshold that most middle-class households either already qualify for or can plan their way into. In 2026, a single American can earn up to $47,025 in taxable income and pay zero federal tax on long-term investment gains. A married couple filing jointly can earn up to $94,050 and pay zero tax on those same gains. 0% on investment profits. Completely legal. Written directly into the U.S. tax code by the IRS. Most Americans who qualify for this have no idea it exists. And the ones who do know about it are using it to let their investments compound tax-free in ways that a standard taxable brokerage account cannot match. This video explains exactly how it works, who qualifies, and how to structure your investments to use it, starting with your current tax year. We are covering what the 0% capital gains rate actually is, the exact income thresholds for 2026, the 3 strategies Americans use to access it, the most common mistake that disqualifies people who should qualify, and what to do before December 31st if you want to use this for your 2026 taxes. This is Wealth Clarity. Let's get into it. Let's start with the foundation, because most people have a fuzzy understanding of how investment gains are taxed, and that fuzziness is expensive. When you sell an investment for more than you paid for it, the profit is called a capital gain. The IRS taxes capital gains differently depending on how long you held the investment. If you held it for less than 1 year and sold it, the gain is taxed as ordinary income, at whatever your normal income tax bracket is. If you earn $60,000 a year and sell a stock after 8 months for a $10,000 profit, that $10,000 is taxed at your ordinary income rate. No special treatment. If you held the investment for more than 1 year before selling, it qualifies as a long-term capital gain. And the IRS applies a completely different, lower tax rate to long-term capital gains. There are 3 long-term capital gains tax rates in the U.S. in 2026: 0%, 15%, and 20%, depending on your total taxable income for the year. The 0% rate applies to Americans whose taxable income falls below specific thresholds. For a single filer in 2026, that threshold is $47,025. For married couples filing jointly, it is $94,050. Here is what this means practically. If your total taxable income for the year, after deductions, falls below those thresholds, you can sell long-term investment holdings at a profit and pay zero federal tax on those gains. Not reduced, not deferred. 0. The profit is yours to keep or reinvest without a federal tax bill attached to it. This is not a loophole. It is not a gray area. It is the standard U.S. tax code applied exactly as Congress intended, because the tax system specifically incentivizes long-term investment holding by taxing it at a lower rate and at lower income levels, at 0. At this point, you might be thinking one of 2 things. Either this sounds too good to be true, in which case, look up IRS Publication 550 or the Tax Foundation's 2026 Capital Gains Rate Table. It is publicly documented and straightforward. Or you might be thinking, my income is above those thresholds, so this doesn't apply to me. And that is where the next section matters most, because there are specific legal strategies Americans use to access the 0% rate, even when their gross income is higher than the threshold. The threshold applies to taxable income, not gross income. And there is a meaningful difference between the two that most people never think to calculate. The key distinction that unlocks this strategy for more Americans than realize it is the difference between gross income and taxable income. Gross income is everything you earn. Taxable income is what remains after the IRS allows you to subtract specific deductions. And those deductions can be significant. Every American gets a standard deduction. In 2026, the standard deduction is $14,600 for single filers and $29,200 for married couples filing jointly. Before any other calculation, your taxable income is already reduced by that amount. Add a 401k contribution up to $23,500 in 2026, and that comes off your taxable income as well. Traditional IRA contributions, health savings account contributions, student loan interest deductions, and business expense deductions for self-employed Americans can reduce taxable income further. Here is what that looks like in a real scenario. A married couple earns a combined gross income of $140,000. That sounds well above the threshold. But subtract the standard deduction of $29,200. Subtract two 401k contributions of $23,500 each, $47,000 total. Their taxable income is now $93,800, just below the joint filing threshold of $94,050. At that taxable income level, any long-term investment gains they realize this year, dividends, stock sales, fund distributions, are taxed at 0% federally. This is why tax planning before December 31st matters so much. The window to make contributions that reduce your taxable income, particularly 401k and HSA contributions, closes at year-end. Americans who calculate their projected taxable income in October and November can often make targeted contributions that bring them below the threshold in time for the current tax year. Here is the specific action that most Americans who know about this rate still miss. It is called tax gain harvesting, and it is the inverse of what most people have heard of. Most people have heard of tax loss harvesting, selling investments at a loss to offset gains. Tax gain harvesting is the opposite. If you are in the 0% long-term capital gains bracket for the year, you can sell appreciated investments, realize the gain tax-free, and immediately buy them back. You reset your cost basis to the higher price, meaning future gains will be calculated from a higher starting point, reducing your tax liability when you eventually sell in a higher income year. It is a legal, documented strategy that lets you permanently reduce future tax liability by taking advantage of a zero tax year. Most people who qualify for the 0% rate never use it this way. Now that the mechanism is clear, here are the three most practical ways Americans access the 0% capital gains rate in 2026. The first strategy is retirement account optimization. Maximizing contributions to a 401k, traditional IRA, or HSA reduces taxable income directly. For many dual-income households, full 401k contributions alone are enough to bring taxable income below the joint filing threshold. This is not exotic tax planning. It is using accounts exactly as they were designed. The second strategy is income timing for self-employed or variable income Americans. If you are self-employed, freelance, or have variable income, you have more control over when income is recognized than a salaried employee. A year with lower income, a transition year, a sabbatical, a business build year, is an opportunity to realize long-term investment gains at 0% that you would pay 15 or 20% on in a higher income year. The third strategy is the tax gain harvesting move described above. In any year where your taxable income falls below the threshold, whether through deductions, income variability, or retirement, selling appreciated long-term holdings and resetting your cost basis permanently reduces future tax liability on those assets. Used together, these three strategies can significantly reduce the lifetime tax burden on an investment portfolio, particularly for Americans who start thinking about tax planning before year-end, rather than at tax filing time in April. Here is the most common mistake that causes Americans who should qualify to miss the 0% rate, and it is painfully simple. They sell the investment too early. The 0% rate only applies to long-term capital gains, investments held for more than 1 year. An investment held for 11 months and 29 days is a short-term gain, taxed as ordinary income at your full bracket rate. 1 day makes the difference between 0% and potentially 22%. Before selling any investment, check the purchase date. If you are 2 or 3 months away from the 1-year mark and your taxable income is in range for the 0% rate, wait. The difference between a short-term and long-term gain on a $10,000 profit could be $2,000 or more in federal tax. This is a calendar check that takes 30 seconds and can save thousands. Let's make this practical for the current tax year, because the window to use this strategy for 2026 closes on December 31st. Step 1. Estimate your 2026 taxable income. Take your expected gross income, subtract your standard deduction, subtract any pre-tax retirement contributions you have made or plan to make before year-end, and subtract any other above-the-line deductions that apply to your situation. If you are not sure how to calculate this, a tax software program like TurboTax or H&M Block will estimate it for you. You do not need a CPA for this step. Step 2. Check whether you are near or below the threshold. Single filer, $47,025. Married filing jointly, $94,050. If you are within range, the next two steps matter. Step 3. Maximize deductions before year-end. If additional 401k contributions would bring your taxable income below the threshold, make them before December 31st. The same applies to HSA contributions if you are on a qualifying high-deductible health plan. Step 4. If you are now in the 0% bracket, review your investment holdings. Identify appreciated positions you have held for more than 1 year. Consider selling them before year-end, realizing the gain at 0%, and buying back into the same or similar position to reset your cost basis. Consult a tax professional if you have a complex situation, but for most straightforward cases, this is a documented strategy with clear IRS guidance. The 0% capital gains rate is not a secret. It is not a workaround. It is the tax system working exactly as intended for Americans who understand it and plan ahead. Most people pay more tax on their investments than they legally have to, not because the rules require it, but because they did not know the rules existed. Here is what we covered. The IRS taxes long-term investment gains at 0% for Americans whose taxable income falls below $47,025 as a single filer or $94,050 married filing jointly in 2026. Taxable income is not gross income. Standard deductions and pre-tax retirement contributions can bring many middle-class American households below the threshold even when their gross income appears too high. The three strategies to access it are retirement account maximization to reduce taxable income timing for variable income Americans, and tax gain harvesting to permanently reset cost basis in zero tax years. The most common mistake is selling investments before the 1-year mark and converting what would have been a 0% gain into ordinary income. The window for 2026 closes December 31st. Estimate your taxable income now. Make contributions before year-end. Review appreciated holdings. The tax system rewards the Americans who understand it. If this gave you a strategy you can actually use this year, subscribe to Wealth Clarity. New videos every Wednesday and Saturday. YouTube is going to show you the perfect next video right now. I will see you there.